trader on the floor today. Have anything to say? I hope you've had a good summer, spent quality time with family and friends, and that you've had time to reflect on life in general and also think a little bit about financial markets. It's getting interesting, isn't it? Today I want to give you a brief insight in how I look at markets. So of course, I've been away for more than a month and have barely been looking at financial markets. Those of you in the Discord server would have realized that my activity levels have picked up significantly in the past few weeks. I would really encourage you to watch till the end of this video. Not only you'll get to see my own process for looking at financial markets and generating trade ideas in quite a bit of detail, but I'm also drawing the curtains on some of the discussions that we've been having recently in the Discord server. I bet you'd want to stay till the end of this video to get an understanding of what we discuss in the Discord server. Guys, everything discussed here is not financial advice. This is purely for educational purposes. Obviously, the main challenge faced by retail traders and professional traders as well is the unlimited amount of information out there. It's very difficult to distinguish signal from noise, right? We need to identify information sources that have predictive power instead of just looking at coincident or lagging indicators. So basically, what has already happened, that's the past. The market is not going to move on past information, that's for sure. So what are the market moving information sources that I look at? Before we get there, I'll tell you what I don't even look at. These are newspapers, financial media, Twitter, blogs, tip sheets, self-proclaimed macro professionals, fearmongers who come on YouTube every single day to try to convince you that the world is going to end, broker recommendations, and so on and so forth. These are just sources of noise. You won't get any signal, anything that's of meaningful value from listening to all these other information sources. So what should we pay attention to? These would be economic releases, surveys like the ISM PMI, ISM services, consumer sentiment, the regional Fed surveys, industry reports as well, for autos, housing, oil sector, commodities like copper, iron ore, gold, and so on and so forth. Another area where I spend a lot of time is company financials, investor presentations, earnings call transcripts, earnings presentation. So basically all the information that's coming out on a quarterly basis from all the companies that are reporting. This is the closest it gets to the truth. So as traders, our job is to basically seek out the truth and try to get closer to the truth as much as possible. Another thing that I would be paying quite a bit of attention to would be changes in analyst recommendations. So are they upgrading a stock, downgrading it, upgrading price targets, downgrading price targets? So what are analysts saying about a particular industry, sector, company? These are the things that I pay close attention to. It doesn't mean that I always agree with them, but it's important for me to understand what the street is actually thinking, and then for me to form my own view on industries, companies, etc., and then decide whether there is an opportunity for me to get involved or not. So remember, as traders, we are first and foremost independent thinkers. This is what we do on a daily basis to be able to find an endless pool of opportunities for ourselves and play them in financial markets. I initially mentioned that as traders, we are focused on information sources that have high predictive value. We are trying to forecast the future, so that makes total sense. However, we also need a lot of context before we can project things into the future. We need to understand what's happened in the past, what's happening currently, and then look at the future. In order to be able to get the right context and put things into perspective, we also look at backward-looking sources of information. These would normally be lagging indicators like GDP rate, unemployment rate, coincident indicators that will tell us about the current state of affairs. So for example, what's happening to the inflation rate, what's happening to retail sales. So all that information does not give you any idea of how the future will play out, but it tells you where we've been in the past, where we're at currently, and then when we mix the context with what the leading indicators with predictive power are telling us, then that gives us a fairly good chance at being able to predict what's going to happen next. As traders, we're always trying to predict the next 3 to 6 to 12 months and then position ourselves accordingly. In terms of forward-looking information, we focus a lot on leading indicators like the ISM survey, the producer price indices, building permits, and so on and so forth. There's a long list of these indicators. We also look at what management is saying in their guidance and outlook. Sometimes they'll give us very insightful comments on the company and on the industry as well as to whether it will grow from here or it will be contracting, whether there's a turnaround story happening, whether the good days for a company and its industry are over, and so on and so forth. It's all a matter of being able to read in between the lines and try to understand what management is saying to us. Going into the week, one of the things that I will normally look at is the economic calendar. What are the different economic releases that will be coming out? We've got quite a critical week ahead. We've got the Fed who will be speaking on Wednesday. We've also got other reports that are coming this week, which are extremely important, like the building permits, housing starts. We've got the Fed interest rate decision, initial jobless claims, continuing claims, retail sales, the oil inventory report, the New York Empire State Manufacturing Index, the MBA mortgage report, and quite a few others. So depending on which industries you're currently looking at, you might have a longer or shorter list. But in terms of macroeconomics, these are the ones that would top your list. Let's look at what the market has been doing recently. By now, it's pretty clear that the Fed is going to cut rates. At least that's what Jerome Powell has indicated in his last speech at the Jackson Hole, right? So bond yields have started to move in anticipation of rate cuts. Basically, what's been happening the last few weeks is literally the bond yields moving lower and lower every single week. When we look at the US yield curve, we can see that rates have been moving down meaningfully across all durations. That's a significant move preceding a significant change in the interest rate regime. The break-even rate, which is basically the US 10-year yield minus the US 2-year yields, are now finally positive after many, many months. I don't really know what it means. Is this the start of a new bull market? Is it the end of the current bull market? No idea. I suppose we'll find out. But the whole point is you can still make a lot of money irrespective of whether you call it right or wrong. I also look at US corporate bond spreads to get an idea of the level of credit risk priced by the market. As we can see from the chart on the right, it's been relatively benign and there's nothing much that the market is worried about at the moment. So for those who don't know, the corporate bond spread is essentially the additional interest rate on top of the risk-free rate, which in this case is the Fed funds rate, that a corporation needs to pay in order to secure a loan. So of course this will vary according to their creditworthiness. A company that is financially strong will have a low spread applied onto the risk-free rate, while a company with a weak balance sheet will have a much higher spread to reflect that additional level of credit risk. When we look at US equities, we normally look at the two main indices, which are the S&P 500 and the Nasdaq 100. Both of them have had a strong week. A large part of it is in anticipation of the rate cuts. One thing to note here is that both of them are actually in a bull market. They've been recovering well from the technical sell-off in August due to the yen carry trade unwind. A large part of the rally in the main indices have been concentrated in the top companies like Facebook, Nvidia, Google, Microsoft, and so on. And for months, we've been waiting to see whether the strength in the bull market will eventually broaden out and pull the smaller companies upwards. When we look at the IWM, we can see that this week it's been able to close above a long-term resistance level. We still need to see whether it will rally onwards from here, but this is a pretty good sign of a potential breakout. We need to keep our eyes open for that. I also like to look at the RSP, which is basically an equal weighted index of the S&P 500. Going back to my initial thesis that this bull market will eventually broaden out, the RSP allows me to see whether this is in fact happening. For the last few weeks, the RSP has also started to break out. So this is a very good sign, indicating that the bull market is still alive, healthy, and broadening out to the smaller stocks. So you might ask, why do we care about price action? Anything that's happened in the market is the past. What's the point of looking at the past? It probably doesn't have any predictive value for the future, right? But there are good reasons why we do a price action analysis. Most importantly, we don't use price action to jump on the bandwagon and tailcoat what has already been working. This is a very dangerous strategy, often referred to as momentum trading. So for example, something has been doing well for the past few weeks, and without doing any work, you just jump into the trade and just hope that it will keep working. That's a very dangerous strategy. What we also need to realize is that the stock market is above all a discounting mechanism for all the information out there. A lot can be gleaned by learning to read market moves and interpreting them correctly. Looking at markets, reading them, and coming out with the right conclusions is the key for success. And it's a very important skill to develop. This can be the linchpin for your success in trading. Price action analysis is basically helping us to put moves into perspective. When we look at price action, we're trying to understand what the market is focused on. We're trying to identify trends. As an example, are cyclicals outperforming defensives or vice versa? Are large caps doing better than mid caps or small caps? Or is capital moving to the small cap market at the expense of large caps? Is there rotation happening across sectors? Is there rotation happening from the higher end of the market, which probably is richly valued, to the smaller end of the market where investors can still find value? We also want to understand, is capital looking for growth or value? Depending on sentiment in the market, at various points in time, the market will be oscillating between growth and value. Price action analysis allows you to have a finger on the pulse of the market. Therefore, using price action, we're able to determine when is a good time to deploy capital into ideas that are already well researched and on our watch list. We are able to time our trades better at a time when the market is also recognizing the same catalysts that we've identified. There's no point arguing with the market. Price action analysis can also be a source for trade idea generation. It can reveal stories happening under the hood that you might not have been paying too much attention to. However, be careful here. We still need to do our own work before putting on trades. Price action analysis also allows us to understand market positioning and psychology. We can identify high consensus crowded trades where there can be a risk of a reversal if investors' expectations are missed. We can take a contrarian view and position ourselves for that potential reversal. This is what we refer to as a pain trade. Looking at the US equities a bit more in detail, let's try to figure out which factors have been doing well and which ones have underperformed. When we talk of factors, we are referring to large cap versus mid cap versus small cap, or growth versus value, or even a combination of all of them. So this week, we can see that growth has recovered, but it's still underperforming on a monthly basis. So again, I think a lot of it is due to the anticipation of rate cuts. We've seen that the underperformance in the mid-cap segment has continued. This is something that we've seen before with the IWM breaking out. So if the rally is essentially broadening out, is small cap an area where we need to be focusing a lot more for trade idea generation? So you see, by doing this price action analysis, we get a very good sense of what the market has been doing, what the market likes, and potentially we can identify fertile grounds for trade idea generation. In this case, I would definitely say that we need to start hunting for long trade ideas in the small cap or even the mid cap segment. Now that we understand the importance of price action analysis, let's move over and actually look at some performances in the market. The S&P 500 was up 4%. Let's compare how the individual sectors within the US equities have performed with respect to the S&P 500. The only two sectors managing to outperform the S&P 500 was technology and consumer discretionary. One thing that's important to mention here is that when you're looking at these performances, it's very important to put things into perspective. So a lot of times when you have sectors doing well on a weekly basis, the question you have to ask yourself is that sector seeing strength, or is it just rallying from an oversold position in the past? The question you're trying to answer is whether capital is coming into a sector because of the right fundamentals, or whether a sector is seeing a rally from an oversold position, mainly because of a short squeeze or because investors think that maybe they can get a deal. And it's critical for us to make a distinction between these two scenarios when we're generating trade ideas, because if money is coming to a sector because of strong fundamentals, then the rally is likely to continue. On the other hand, a sector with weakening fundamentals can see rallies occasionally on the basis of a short squeeze. So a lot of times we'll see what we call the bear rallies, and these don't tend to last for long. And we have to make sure that we don't get trapped by going long such stocks that don't have the right fundamentals to carry them further. And of course, the same will apply on shorts, just flip the script. We are definitely in a bull market, but the market has been struggling to find the next leader that will take this rally further. Another thing that we've noticed is that real estate has been having many weeks of outperformances, and that's on the back of rate cut anticipations. We're also starting to see a sell-off in the energy sector. We really have to ask ourselves what's driving this. Are there demand concerns because of GDP growth slowing down and that's impacting the oil market? I think this is something that we have to look into because we're just at the start of possibly a trend that will keep happening for the next few months. So definitely something to stay on top of. We've also seen some strength in the materials and industrials performance, which is at odds with what's happening on the manufacturing side. So on one hand, ISM reports are trending downwards, indicating more contraction. And on the other hand, we've got materials and industrial stocks performing well. So we really need to distinguish which is which, because there could be a risk that materials and industrial stocks fall quite rapidly here if the ISM keeps contracting. So I hope this is showing you how we can use price action analysis to identify areas where we can find great long and short trade ideas. Let's get a bit more granular now and move from the sector to the industries level. It's been a strong week for gold miners, particularly as the gold price has kept rallying. We've also seen a recovery in semiconductors, which bodes well for the technology sector. Home builders, software and internet stocks have also been performing really well, especially in anticipation of rate cuts. As we mentioned, oil producers and services have been major underperformers. I think this probably is the beginning of a new trend, and this is something we need to keep watching. We've also started seeing agriculture stocks underperforming in light of the slowdown and weakness in agricultural commodities prices. In order to put things better into perspective, I also like to look at sector performances within the European equities. As we can see, the European index itself was up 1.82% on the week. Tech has clawed back its underperformance over the last month. Chemicals, materials and industrials are outperforming despite contractionary PMI data. We've also seen the same thing happening in the US, and this is definitely something that we have to investigate a bit further. The auto sector has been a weak underperformer for weeks. So we've been hearing a lot of news regarding EV production, reduced production of autos, and this is definitely being reflected in the stock performances. The oil and gas sector has been underperforming on a monthly basis, but last week it had a decent performance. I'm still bearish on the oil and gas sector, both in the US and EU, and I think last week's rally is an opportunity for us to be looking to put on more shorts into the portfolio. Now let's move on to trade idea generation. This is an area where a lot of traders struggle. The reason we do this price action analysis is to give us a backdrop of what the market is focusing on, where capital is moving in and out of sectors, industries and stocks. This not only allows us to identify areas that might be fertile for both long and short trade ideas, but it also gives us a sense of whether the timing is right to put on these ideas. So I mentioned at the beginning that we look at leading indicators quite a bit. The ISM manufacturing report in the US allows us to form our view on different segments of the manufacturing sector. The ISM PMI came in at 47.2 in August. This was marginally better than July, but it's still in contractionary territory. So just a quick reminder here, if the ISM number is below 50, it indicates contraction. If it's above 50, it means expansion. The ISM new orders moved down to 44.6 in August from 47.4. This indicates contraction at a higher rate, which has essentially sparked growth concerns in the market. The ISM new orders index can itself be thought of as a leading indicator for the ISM PMI index. So it's very important to look at the ISM new orders, especially when it's indicating contraction at such a high rate. These are some comments from the ISM manufacturing report. So I've highlighted a few areas that could be of interest. In summary, there is a reluctance in manufacturers making large capital investments and investments in inventories because of future uncertainties linked to the rates policy and also linked to the elections in November. As you can imagine, depending on the winner of the elections, things could look very differently into the future, especially from a policy-making perspective. Quite interestingly, this slowdown is now moving along the value chain, leading to more job losses. So I think this is why the Fed has come out a little bit more anxious than before, especially regarding the strength of the job market. As I mentioned on one of my previous videos before, I think it was the one on trucks. I'll have the link somewhere so you can reference to it if you want to. The ISM report also gives us quite a bit of detail and color on the different segments of manufacturing. So one of the areas that I look at more closely is the new orders component. This gives us a breakdown into what's happening at different segments within the manufacturing sector. So a positive number indicates expansion and a negative number indicates contraction. In summary, we still have a poor outlook for machinery, fabricated metal products, and transportation equipment. The newly contractionary segments are plastics and rubber products, printing and related products, and chemical products. So these are the areas where we potentially could start looking for shorts. While researching these segments for shorts, we have to make sure that this is the start of a new contractionary period and that it's not only going to be a 1 month thing. On the other side, we've also got a few sectors with positive outlooks. Computer and electronics, paper products, and wood products are showing better prospects than before. So these could be some segments where we start looking for long trade ideas. What's interesting here is that I've only mentioned a few ideas. There are numerous more combinations of longs and short trade ideas that you can find if you dig deeper into the report and do your research correctly. I think that's what's fascinating with the ISM report. The ISM is definitely a great source for trade idea generation, especially in a market where dispersion is increasing. What does dispersion mean? It means that there is less correlation between stocks. Stocks with improving fundamentals are separating themselves from the pack, while stocks with weakening fundamentals are actually falling quite significantly. For us as traders who are looking for long and short trade ideas, this is amazing because we can have great performers on both the long and short end. This gives us even more detail as to what's happening within each individual segment. You can pause this video and read these comments and figure out what's actually happening within the manufacturing sector. This will definitely point you in the right direction for trade idea generation. Where I find traders really struggling is that there are thousands of stocks actively trading on the market, and they find it very difficult to know exactly which one to start looking at in terms of generating trade ideas. So the ISM report is not only predictive, but it also narrows it down to individual segments which might be fertile ground for both long and short trade ideas. The ISM Services PMI came in at 51.5 in August, which was basically flat from last month, while the ISM Services new orders came in at 53 in August from 52.4. So the ISM Services new orders is indicating a little bit of expansion. So similar to the ISM Manufacturing report, the ISM Services also gives us great color at a segmental level. I've got a snapshot of what's happening to the new orders for different segments within the ISM Services. And again, you can do the same exercise as the ISM Manufacturing report to generate your own trade ideas. So feel free to pause this video and then look at these numbers and think for yourself. Once more, this points us in the right direction and allows us to take advantage of all the dispersion in stock performances in the market. I think it gives you a great sense of where to start looking for long and short trade ideas. And finally, for the guys who are not on our Discord server, I wanted to share with you what's happening over there. There's been a lot of discussions between myself and the members in terms of what we think of the macroeconomic picture, idea generation. We've also discussed specific individual companies from both a long and short perspective. We've also done an exercise in terms of trade structuring with individual members. And I speak on behalf of the members. I think there's been fantastic learnings within the Discord server. So if you're not on the Discord server, you're definitely missing out. One of the areas of focus has been in terms of where we see markets going in the future. For us to be able to predict that reliably, we need to understand what market participants are thinking. In one of my comments, you'll see that I've broken the markets in two segments. The hard lending camp is basically the ones who believe that GDP growth will decline, which will inevitably reduce corporate profitability, and therefore this will be bad for stocks, specifically for cyclical stocks. The soft lending camp are the ones who think that the Fed can pull it off, that the Fed is being preemptive in its action, and it will be able to soften the blow to the economy by managing interest rates accordingly. So I don't really know which way things go, but it's important to understand what's driving markets. And if you look at the price action, you'll see that it's an interplay between these two camps. So basically, the hard lending camp should be looking at taking profits on cyclical companies and even shorting such companies where they think growth will come down eventually. This camp will not give benefit of doubt. They'll sell and then ask questions later. The second camp, which is the soft lending camp, I think is a bit more optimistic. They will tend to buy good companies that will perform irrespective of the market conditions. They will also be the dip buyers for many companies. And as I've mentioned, I think the price action over the next few weeks will be an interplay between these two camps as they keep adjusting their portfolios based on how risk on or risk off they want to be. We've also been discussing the oil equipment and services segment quite a bit in the Discord server. So I'm not going to go too much into detail. You can pause the video and read these comments yourself. But remember, the real value here is to be able to have these discussions in real time and learn from guys who've done this for many, many years. And here's another snapshot in the oil equipment services segment. Here I'm explaining the landscape of the industry, so our Discord members are able to quickly understand how the industry is set up and therefore generate trade ideas from there. Within the Discord server, we've got threads to discuss the ISM manufacturing and ISM services reports every month as they come out. And from there, we try to generate as many ideas as possible. So you'll see here I've made some comments on the accommodation and food services industry. This undoubtedly allows our Discord members to understand these industries fairly quickly and also serves to point them in the right direction. At the end of the day, we don't want traders to be stuck in rabbit holes and to be spending an exhaustive amount of time in their research and not coming out with high quality, high conviction trade ideas. The success of traders depends on their ability for generating trade ideas week in, week out. Traders need to have a rich watch list, which eventually gets converted into live trade ideas. That's the importance of having a rich watch list, which in itself is a result of having an effective trade idea generation process. And finally, we also discussed some themes in the Discord server. So again, everything that I'm discussing is to try to point our Discord members in the right direction so they can find trade ideas effectively. A lot of times what happens is traders lack the creativity to be able to find ideas across different sectors. So having the Discord server as a resource at hand really helps them to think laterally and arrive at their own trade ideas. So if you're not in our Discord server, one thing's for sure, you're absolutely missing out. So guys, if you'd like to join the Financial Traders Hub Discord server, there's a link below. Click on the link to subscribe. It's absolutely free, but I cannot guarantee you that it will stay that way for too long. I hope I've shown you enough today so you can decide whether you need to be part of our Discord server or not. Whichever way you choose, that's perfectly fine. We'll still be generating tremendous trade ideas within. So it's up to you to decide. Don't forget to like, subscribe, and drop your comments below. I'm really interested to see if this video was helpful, if you took away any insights, and also if you've got any questions that you'd like to ask me, feel free to drop me a comment and I'll get back to you as soon as possible. Feel free to drop me a comment and I'll get back to you as soon as possible. On this note, happy trading guys, and I wish you all the best out there.